Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. Before I begin, I once again want to say my thoughts and prayers go out to the people of Ukraine, especially my friends, colleagues, and any of you with friends and family that are impacted in any way. And it was the Russian invasion of Ukraine that obviously dominated markets, with fears of escalation early in the week causing a surge in energy prices, which drove risk assets lower and drove a stagflation theme around the markets. That was replaced midweek by some optimism about conciliatory comments from both Ukraine and wanting to negotiate, and Russia potentially dropping a few of their more minor demands. And markets are certainly looking for any sort of hope for a diplomatic solution. I hope I'm wrong, but I don't see a lot new here from the Ukrainian side, who are unwilling to concede an inch of territory, in their words, or the Russian side, whose long list of unacceptable demands just went to a slightly less long list of unacceptable demands. So, like I said, I hope I'm wrong. One thing is for sure, historic volatility in commodities and other asset classes is likely to stay here for a while. And, based on everything that I've seen and read, it seems to me that this situation is not likely to resolve anytime soon. Fingers crossed it does, but I think we need to be prepared that it doesn't. So back to that word I mentioned before, which is stagflation. The rationale behind this is gaining steam is an obvious one. Rising inflation in the old days of a month ago was just a sign of strong demand and an output from a strong global economy. So that was a good kind of inflation. Now, however, we've switched it over to the bad kind of inflation, commodity-driven price hikes that act as a tax on consumers and businesses, and not driven by pure strengthening underlying demand, but it's more of a supply issue. This is a situation that is generally not just unpleasant, but bad for consumers and businesses, but also bad for a lot of asset classes outside of the commodities that we talked about. So it's here that I want to welcome this week's guest, Giovanni Zanni, our chief European economist, who has the unenviable task of attempting to figure out how all these recent developments impact both growth and inflation in the economies that are closest to the war. Gio, thanks for joining us. So first, you cover the eurozone, obviously the closest zone, most impacted economically. What are your thoughts on some of what I just discussed? Do you think that stagflation environment's a real risk in the eurozone? It's certainly gaining a lot of momentum and discussion.
Well, certainly the shock is stagflationary in nature, so it will lower growth and increase inflation, at least in the short term. But I would say that we are in a situation where the baseline was one where you were normalizing the economy after the latest Omicron wave, and so that there's still some growth there. So of course it's going to be lower than the pre-war baseline, but I don't think we're going to have stagnation. So if you have to look at the economic situation relative to today, I still think that we can grow in a sense. Of course, it would be a lot less than before. So there are estimates of that go from just 0.5 percentage point to around 3 percentage point currently, and the middle ground now of that is probably a good and realistic scenario. And in terms of inflation, of course, we're talking, depending on what's happening to energy prices, but we're talking about 1 to 2 points of inflation, definitely.
If you would just say there was a bigger one of these risks, do you worry more about the stagnation of growth or a medium-term inflation rising and then staying sticky? Where do you think is the most vulnerable? Which side of the coin?
Well, we were, and we are even more so in an environment where we are going to push growth for a lot of reasons. So because of defense expenditure, because of reconversion of energy. So there's a lot of things that have to be done. There will be support from fiscal policy as well. There is this Versailles meeting already today as well on the fiscal front and on all this kind of fiscal policy side. So I think that, beyond the kind of short-term impact on growth, the idea is that growth will remain resilient. And in the face of that, of course, inflation is the thing that is more, vulnerable in the sense of getting even higher or more persistent, let's say. So, I don't think that growth is at risk, but I think that, inflation the bias could be still higher.
Yeah, and that certainly seems to be what the ECB is looking at least from the headlines. Though, as you've noted elsewhere, the press conference had a little bit more context around it, but still we're seeing front end yields rising in reaction to the ECB, ending asset purchases perhaps sooner than expected, or a more hawkish result there. What's your, given all that context, worries about it? I mean, what do you take from the ECB here, and what are the implications for policy?
Yeah, I mean, from what I said, I mean, I think it makes sense in a very general macroeconomic without uncertainty kind of context. But having said that, I thought that the decision from the ECB was unnecessarily hawkish and has some elements of policy mistakes, to be frank. And if you look at also how Lagarde presented it, she tried to tone down a little bit the introductory statement during the press conference, but she also said that basically there were a lot of people that were much more cautious, and others in the council that were a lot more hawkish. So this is not really the view of the ECB, a stable view. I think that things will change again at the next meeting, and so this is like an intermediate step. And as I said, I mean, I don't think that was the real message you wanted to give today, because of the uncertainty, because of the war. So I would have remained a bit more cautious. Markets would have liked that. It's true that the reaction in markets, apart from this kind of immediate reaction from the ECB, has been relatively muted, so and orderly in terms of financial stability so far in Europe. So that's a good thing. But it's just, I wouldn't risk that with the kind of statement that I heard today from the ECB. So.
Yeah, and that's the thing that struck me. I mean, you almost said it almost perfectly, but the idea that at this moment, especially in the eurozone, that the ECB felt it was appropriate to kind of potentially add volatility into markets. I mean, even just from a market perspective, never mind the inflation mandate, given everything going on, I would have thought, and to be honest, I would have thought this, including the Fed and the Bank of England coming up the next week, is that you want to be, kind of advance along your previous outlined goals, but don't necessarily create more uncertainty at a time when there's vast amount of uncertainty. And especially in Europe, when we've talked about defragmentation and sovereign spreads and potentially credit under pressure already from Ukraine, announcing a potentially quicker end to asset purchases right now, it just seems like it would have been a lot easier to wait. But I'm sure we'll get some sources articles, as we usually do, to give us some dynamics on what's going on inside the ECB. But yeah, no, I'm with you. I would have thought that given the geopolitical instabilities and uncertainties, this is not the time to kind of throw another big rock in the pond when previous ripples are still working their way out. But anyway, thank you, Gio. Appreciate that. And good luck given everything's going on. Like I said, it's an unenviable position right now, but appreciate your thoughts. So that's all for this week. Obviously, we'll all still be watching the developments in Ukraine, but this coming week, as I mentioned, we also have the Fed and the Bank of England meetings. So, there's probably a little bit now rising hawkish expectations, I would think, after the ECB into those. So we'll see how they react. Both are more distant from the conflict, but also, as Gio noted with the eurozone, you're starting at a higher level of inflation and adding more on headline inflation on top. Do they try to look through it, or do they take a more hawkish approach? I think is going to be, in addition to Ukraine, the main topics of next week. So that's all for now. Have a great week, everyone. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.